We ready to go? All right, well, good morning, everybody. Happy weekend, happy Saturday, and welcome to the Money Speed Date. I'm so excited to be doing this. I'm Tshepo Kgapane, and of course, the host and the founder of Youth Money Circle. And we've now had to move our events from physical events to webinars. And I'm so excited to be doing that with you guys. And as per normal, financial education for us should always be fun. It should be cool. It should be interactive. It shouldn't be boring with long words and things that are going to confuse you. So now the question is, what is the Money Speed Date all about? So we came up with the Money Speed Date because of COVID-19. Not only have people lost their lives, people's livelihoods have also been affected. Some people have lost their jobs, through retrenchments. Some people have experienced reduced incomes. Some people are struggling to find a job. And the thing that kept coming up in my mind is, what does this mean for my money? What am I supposed to do with my money during COVID-19? So I thought we should go on a date. Let me get two amazing speakers from the Allan Gray family who will tell us what we should be thinking about during this time in terms of our money. So I'm going to be introducing two amazing women who are part of the Allan Gray family. I'm going to be introducing Nomsa Ngwenya and Emmanuella Fernandes. And I want them to tell me, what is their role at Allan Gray and what did they actually have for breakfast this morning? So I'm going to be taking it over to them, and we'll start with you, Nomsa. What is your role at the Allan Gray family and what did you have for breakfast this morning?
Thank you so much, Tshepo. Good morning, everyone. My name is Nomsa Ngwenya, and I'm a client relationship manager at Allan Gray. I'm part of a team that focuses on delivering educational content around personal investing to individuals. That's really what I do. I'm passionate about that. I'm passionate about empowering people to be financially literate and financially independent. That's what I do. Yeah. What I had for breakfast, I had a KFC brekkie. I don't know if you know it.
Okay. Yes.
Yeah, that crunchy brekkie. It was nice. Yeah.
Okay. Emmanuel, and you?
Hi, Tshepo. So yes, myself, like Nomsa, I'm a client relationship manager at Allan Gray. So we do the same thing. We educate people on what we deem is important when it comes to savings and investments. And for breakfast, I'm a little bit naughty. I also love coffee. So I've had about 3 cups of coffee for breakfast.
3 already? It's fine. I don't blame you. I'm also a little bit of a coffee addict as well. Super. So to all the participants, thank you so much for waking up, for tuning in, for coming on this date with us and Nomsa and Emmanuella. And if you have any questions, we've got the Q&A box right at the bottom where you can go and ask any money questions that you might have. We've already collected some of them when you guys were registering. We already collected some through social media and our emails. But there's 4 main things that we're going to be covering, right? 1 is, what does COVID-19 mean for my money? 2, the importance of having an emergency fund. 3, financial lessons that come out of COVID-19. And 4, how do you deal with, financial stress? I've felt myself a little bit under pressure. So those are the 4 main things that we'll be dealing with. But in the Q&A box, go there, ask us whatever questions you may have. But now the date is about to begin. We are going to learn a bit more about our money. And so I'm going to be handing over to Nomsa and Emmanuella and covering those 4 important topics. But do send all your questions in the Q&A.
Thank you so much, Tshepo. Good morning again, everyone. Just to go back on the agenda, what we will be covering this morning, I'll just do a brief introduction to Allan Gray. I think it's important for people to know who Allan Gray is. And I'll also touch on exactly what does COVID-19 mean for my money, the importance of having an emergency fund, and some of the lessons that we can take from COVID-19, and how to also deal with financial pressure. So Allan Gray is a privately owned investment management firm. We were established in 1973. We have just over 486 billion rands of assets that we are managing on behalf of our clients. We have an affiliation with our sister company called Obas. Obas also was started by the same person who started Allan Gray, who is called Allan Gray. So they do what we do, but on a global exposure. They have just over 30 billion US dollars of assets assets that they are managing on behalf of our clients offshore. At Allan Gray, we have 1,418 employees and 23 investment professionals. So you may ask, Nomsa, why are you isolating these investment professionals from the rest of the employees? It will make sense later on in my presentation. So Allan Gray has offices in South Africa, in Namibia, as well as in Botswana, while our sister company has offices in Canada, in the United States, in Bermuda, in the UK, in Luxembourg, in China, as well as in Japan. So our purpose at Allan Gray is to actually help clients build wealth over the long term. The picture that you see right now, it is an actual representation of our clients. Emmanuella and I are here this morning to actually tell you that you don't need to be super rich in order for you to invest with Allan Gray. You don't need millions. You don't need to have a special or an important title in order for you to be a client at Allan Gray. We are here really to help people who want to build and live a financial legacy. Anyone can invest with us, provided they understand our products as well as our investment philosophy. I think it's important for people to understand our investment philosophy because it is our DNA. It is what guides us to make decisions on behalf of our clients. You know, those 23 investment professionals that I alluded to earlier, they are responsible really for going in the market and looking for investment opportunities, that is to buy businesses. And what we buy is really businesses that are trading at a discount. That is, they are trading below the intrinsic value. The intrinsic value measures how much a prudent businessman would be willing to pay for this particular business. And sometimes that business can be trading below that because of market noises and also looking at, COVID as well. Some of the businesses really went below their actual value. So we look for those opportunities to buy them. And then we keep it until we sell it at a point where it has just gone above the intrinsic value. So we repeat the process over and over again. It may sound simple, but the trick is really how to implement it. So we've been able to implement this investment philosophy for over 40 years now, and also in different market cycles. And it has allowed us to generate returns and help our clients build wealth over the long term. Global financial markets have been hit hard by the COVID-19 pandemic. And the graph that you are seeing right now, it is the all-share index and the performance of this all-share index, which really is a representation of the South African stock market. As you can see, there was a massive decline of about 34% in March. What this tells us is that South Africa was definitely not spared from the pandemic. We've actually experienced one of the greatest market crashes in over a decade. But what we can see also from this graph is that the markets were able to recover quite quick and strong, and we're almost back to where we were at the beginning of the year. But this does not take away the fact that it has been tough for investors to stay invested. Markets move up and down, and it is largely driven by our emotions. The stock market is a representation of people's emotions. Markets go up when people are excited about the future, and they go down when people are less excited about the future. As we navigate the impact of the COVID-19 pandemic on ourselves, our families, our friends, our colleagues, as well as our communities, it can be hard to think beyond tomorrow. But however, in order for you to achieve investment success, you need to strike a balance between solving for your current needs, but also keeping your long-term goals firmly in mind. Some of your goals could be having an emergency fund, building your emergency fund. So what we've learned from COVID-19 really is the importance of having the money available for short-term access in an event that something happens. And also what investing can also help you do is that it can help you plan for your personal goals. Your goals could be, you want to go on a holiday, you want to buy a car, you want to buy a house, you want to celebrate your birthday, whatever it may be. So when you've got money put aside, it is able to help you achieve those goals without you taking on debt. And what investing can also help you do is to plan for your retirement. According to the National Treasury, they say that only 6% of South Africans are able to retire financially independent. The rest of the people have to depend on family. They have to depend on the state pension. Some have to continue working even though they've reached the edge of retirement. So what these numbers are really telling us is that it is important for us to have these conversations, to talk about money so that we can plan for our finances. So an emergency fund, really, it is important because it helps you to make provision for those, unforeseen events that may take place in life. That is, you don't compromise on your financial standing or get into more debt. What we have all been reminded of in this year 2020 is that, how quickly our lives can change. Circumstances can change as quickly as, you didn't even anticipate. Really, the role of an emergency fund, it is to kind of help you plan for those unforeseen events. So as individuals, really, we tend to be, more optimistic about the future. Most of us here do not start the year anticipating that we are going to experience a salary cut, or you're going to lose your job, or you're going to be faced with medical emergencies or pandemic for that matter. We hear people say things like, if you fail to plan, you are planning to fail. What that means is that, it becomes true when it comes to our finances. So in your goal setting, in your financial plan, it is important for you to have money set aside to make provision for those unplanned expenses that catch us all off guard and they try to eat into our budget. So these are some of the 4 steps that I've provided you to help you when it comes to building that emergency fund. Think about liquidity. By that, I mean, when you invest your money when you put your money in an emergency fund, you are looking at money that you'll be able to access, that is in a short term. So that is, it must be put in an investment that is able to preserve your capital. And also what you're looking at is that it is accessible at any point in time when you need it. And try to separate your emergency fund from your day-to-day expenses. This will help you avoid dipping into that money now and then. So something like, for example, a money market fund, Allan Gray offers it, other service providers do offer money market funds. They are there to really help you with your emergency fund because it is able to give you returns higher than a bank deposit, and it is available for short-term access when a crisis strikes. What you also need to be looking at when it comes to your emergency fund is setting a target. Your emergency fund is going to be shaped by your personal circumstances. But what we see is that financial advisors always encourage their clients to put money aside in an emergency fund that is able to cover about 3 to 6 months of their monthly expenses. What that really means is that whatever you may have, it will be able to help you manage and recover from that crisis. What you also need to be looking at is reviewing that emergency fund now and then. That is, when your income changes, when your expenses change, do make sure that you update also your emergency fund, so that in your broader financial planning, whether you're setting your new year goals, whatever it may be, do consider reviewing your emergency fund so that there is enough money put aside for your needs. What you also need to look at is trying to break the barriers that kind of delays us from starting. I know we've got different responsibilities, things that you are taking care of, and sometimes these things discourage you from building your emergency fund. But what advisors always encourage people to do, let's say you are already paying debt, there's debt that you are covering, and you feel like, I'm pressured financially, I can't have an emergency fund. What you need to do is try, when you are paying your debt, also try to be putting money aside for your emergencies, because that will help you avoid getting into more debt when something happens that is unplanned. And also, financial pressure, Emmanuella is going to touch on this, but really, when is it the right time for you to build an emergency fund? I believe really it is right now. So do a review of your finances. We are going to start a new year, and I know most of us are going to be setting new resolutions, goals for 2021. Do also look at your emergency fund in your goal settings for the coming year. So, as I've already said, personal finance really is shaped by your personal circumstances. You may be receiving an income and your money can be going towards goods and services. That is the money that you spend. You could either spend it towards your needs as well as your wants. And the money that you do not spend, it is divided between your saving as well as your investments. I know these terms are sometimes used interchangeably, but they really don't mean the same thing. So when we're talking about saving, we're talking about short-term access access, that is the money that you put aside for the short term, that is speaks to your emergencies. And the risk of capital loss is low in that type of an investment because it aims to preserve your capital, and what you are going to be earning there, it is just interest on the capital that you have. So savings account generally don't beat inflation over the long term. So really, if you're planning to invest for the long term, a savings account may actually not be able to benefit from the market. That's where investing comes in. So if you're planning to put money aside for the long term, that is, you're thinking of 5 years or more, and it's something maybe for your family or personal planning that it could be. So something like an investment account can help you with that, because what we're doing is we are buying assets that we believe are going to generate you returns over the long term. That is, you're going to get capital growth and you're going to earn dividends on that money. Yes, there is a possibility of market movements that can affect your capital. So it's important for you to be willing to take that bit of risk. But the benefit with that is that if you stay the course, if you stay the long term, you'll be able to benefit from that investment account, because investment accounts really over the long term, they tend to beat savings account when it comes to returns. So at Allan Gray, if, for example, you're planning to build your emergency fund, you can use what we call our basic investment account. It is called a unit trust account. This account is not only unique to Allan Gray, other service providers may offer it, and this really helps you with your flexible goals. That is your short term, your medium term, as well as your long term goals. But when we are looking at emergency fund, that is your access and flexibility. This can help you, and the minimum to start that investment is a debit order of 500 Rand, or you can do a lump sum as well of 20,000. That is the minimums that you can choose to start with. Yes, you'll be subject to tax because you're going to generate some return, and that is going to be interest. You're going to get dividends as well as capital growth, depending on the type of a portfolio that you are invested in. So when you do your filing at the end of the tax year, do remember to contact Allan Gray to request for your tax certificate. And the nice thing about this basic investment account is that it is able to give you an exposure offshore. I know someone in the questions that were pre-submitted asked us, how can I invest offshore to try and avoid like minimal cost? And because sometimes when you're moving money offshore, you have to pay for exchange rates and all of those things. So our basic unit trust is able to give you exposure offshore without having to pay those additional costs. That is, those feeder funds are invested through our sister company, Obas, that I spoke about earlier. What we also have is what we call a tax-free account. So a tax-free investment was really introduced by the government to kind of encourage people to save. This investment really benefits for someone who wants to invest for the long term, but we've actually seen people use it also for their short-term goals. So this account is open for only natural persons, that is individuals. You can invest it for a minor charge as well. And the minimum there is 500 Rand debit order or a lump sum of 20,000. But the cap with the tax-free investment is that you cannot contribute more than 36,000 within a tax year. That is, if you've got a tax-free account, whether at Allan Gray or with another investment manager, you have to make sure that your contributions within the tax year do not exceed the 36,000, because if they do, you'll be liable for a penalty. And what a tax-free investment account is able to help you do, it is to plan for your estate, as opposed to a basic unit trust where in an event of death, it forms part of your estate. But a tax-free investment account, it will go to your beneficiaries. So you are able to nominate a beneficiary that is in an event of death, and all of your benefits will go to that particular person. So in terms of the assets that Allan Gray invests in, so we invest in a different range of assets, such as cash, we invest in bonds, we invest in property, we invest as well in equities. Really, we're trying to cater for different types of investors. We've got investors that are very risk averse and they prefer just putting their money in cash-like instruments. And we've got people that are willing to take on risk. Like, for example, people that are young, they're willing to take on risk because they feel like, I still have time. So some of those people will put their money in something like an equity fund, which is able to generate them capital growth in the long run. So at Allan Gray, so now you have decided that you want to build this emergency fund. You want to do it through Allan Gray. So these are different portfolios that we can offer you. Looking for it from the short-term capital preservation account, fund, you are looking at something like a money market fund that I spoke about earlier. So a money market fund really is there to help people that want to invest their money put their money aside for the short term, and they want to, they don't want to expose their money into too much risk. That is, a money market fund can help you with that. And we normally encourage you to put the money for at least a year or so. So if you're looking then for something long term, something like an equity fund can help you do that. But with that, you are bringing in more risk to your investment because it is high risk than the money market fund, which is lower risk. And in between that, we've got a stable fund as well as a balanced fund. These portfolios, in a way, they're almost similar, just that the stable fund is more conservative in that it doesn't take too much risk when it comes to exposure in equities or shares. So really, these are different portfolios that you can choose, whether you are building your emergency fund, something like a money market fund, or you are planning for your long-term goals, something like a stable fund or a balanced fund, as well as an equity fund can help you achieve those goals. At this moment, I'll hand over to my colleague, Emmanuella, to chat to us about some of the financial lessons that we can take from COVID-19 and also to help us in terms of how do we deal with financial pressure. Over to you, Emmanuella.
Thank you, Nomsa. So when it comes to long-term wealth creation, there are two key roles. One is what we do as an investment management firm, and that is to provide superior returns and outstanding service. And two is how you respond as an investor, and this is called investor behavior. And the difference between investment return and investor return is called the behavior gap. So say, for example, Allan Gray finds an opportunity that's only going to come to fruition in 4 to 5 years' time. But the investor decides not to stay the course and either withdraws their funds or switches from one fund to the next. So this just speaks to being invested in the incorrect fund. So it's important for us to understand that shares don't move in a straight line, right? They fluctuate in the market. They go up and they go down. So say, for example, we come to hear of a particular share or stock that's gaining traction in the market, and we rush out and buy the share without considering whether it's suited to our needs as well as our time horizon. And more often than not, we're buying the share at a premium. And then what happens a few days or a few weeks later, the share price drops and fear trickles in, and the investor decides this is the worst decision that they've ever made in their life and thereby withdraws their funds. So they lock in their losses. So in this example, the investor's done the opposite of what the adage says. The saying says, buy low, sell high, and here we've bought high and sold low. So we believe it's best to spend time in the market rather than trying to time the market, because in the long run, shares tend to deliver an inflation-beating return. So if you forgot anything that we said, if you can control your emotions and hold on to that investment through that volatility, you are likely to enjoy good returns over the long term. So one of the financial lessons that we take from COVID is it's important to stay in the game and have a long-term mindset to benefit from the power of compound interest. So if we have to look at our spending habits, right, there's no absolute right or wrong answer. As long as you're comfortable at the end of the day with where you are spending your hard-earned money. So have a look at your bank statement. This provides an honest reflection of where your money is going. And that's probably why we often shy away from doing things like budgets. So in the good old days, this is how we used to do a budget. We had to scrutinize our bank statements, and it's very monotonous. But now there's various apps that are available that can help you to plan your budget. So counting where your cents go doesn't have to be so daunting. This is the recipe for creating a budget. So we all have a pot of income, whether it be a primary job or money that we earn on the side from a side hustle, or perhaps even pocket money. This pot of income needs to be split between our wants, our needs, and our future self. So this idea of including savings in your budget may sound a bit strange, but it's a very important concept. Our wants and our needs make us happy today, but we also need to look after our future self and the person that we want to be one day. So in our next section, we'll provide you with a few tips and tricks of little things that you can do to ensure that you get on the right path. So as the slide says, personal finance is exactly that. It's personal and it's different for different people. So what might be important for me might not necessarily be what's important for you. So it's important to understand we all have different goals, different needs, and different wants. So where do we all start when it comes to investing? The first port of call is to start with a plan. So what is your plan? What are your short, medium, and long-term goals? And then it's to draw up a budget. So budgeting is simply the process of creating a plan around how you're going to be spending your money. So this should benefit everyone, irrespective of your circumstances, as it allows you to understand your current situation. Arguably, an important first step before deciding where you want to go. So you wouldn't start a long-term journey, for example, to a new country without figuring out how exactly are you going to get there. And the same rings true with investing. So equally, a spending plan helps you calculate how much money you have for the things you need and to focus and prioritize your money on the things that are most important to you. So we can't always avoid credit. Sometimes there are things that are really important to us that we can't afford to buy in cash. So there's good debt and there's bad debt. And we need to look at how do you manage your debt? And if you can, look at paying off your debt quicker than anticipated. Now, we're not saying that all debt is bad. So for example, some good debt would include student loans or perhaps bond repayments on a property. And bad debts will include, the likes of, if like Tshepo said, if we hung over on those Black Friday deals, when we're acquiring things that we might not necessarily need, but we buy them anyway. My next slide is quite interesting, right? Because if we have to look at a car is an asset, but it is not an investment, right? So hashtag Skaba chance or hashtag Skaba hemisa. We all know that cars are a depreciating asset. So that means as soon as you purchase that asset, the value starts decreasing over time. So as you can see by this graph, within the first year of purchasing a vehicle, that value drops by at least 30%. So then we have to look at the opposite side of the spectrum. If we had to take that money and rather than purchase a depreciating asset, maybe we can purchase an appreciating asset. So if we had to take that same amount of money and invest it, you'll see the very opposite picture playing out. So what exactly is the recipe for financial success? The first one is to know your spending. So take stock of where you are and where you would like to be. The second trick that we can offer is to create a budget and remember to include your savings as part of that budget. There's, often I hear of people saying, if there's money left over at the end of the month, then I'll put money aside and save that money. But reality is, there's never really money left over at the end of the month, right? Some of us are living from paycheck to paycheck, and that's perfectly fine. And there's this beautiful saying by Warren Buffett that says, do not save what is left after spending, but rather but rather do not save what is left after spending, but rather spend what is left after saving. And avoid bad debt. So yeah, one of my colleagues often says she uses a credit card test, and that just means, if you have to purchase something on a credit card, then perhaps it's not necessarily a good idea. And then one of the last concepts that you need to consider is to be patient. So when it comes to planning for the future, we have to be patient. And patience is something that we can learn over time. Financially, patience is very important because we can grow our money over time. So I love this quote that says, someone is sitting in the shade today because someone planted a tree a long time ago. So think about why it is that you started. Ensure that your investments are aligned with your goals and have a disciplined approach when it comes to investing to benefit from the power of compound interest in the long term. So thank you everyone for joining us. I'll now hand over to Tshepo and we can take some questions that the audience members might have.
Super, thank you guys so much information. So if you guys have any questions, right at the bottom is a Q&A tab. Just click it, and whatever money questions that you guys have, put them there, because the date is all about the questions. You don't go on the speed date and ask nothing. You want to get to know the person a little bit more. So this is an opportunity to speak to experts that have been there, that have seen it all. So ask any of your questions. But there's a couple of things that I'm going to ask and touch on with Nomsa and Emmanuella while you guys think about some of your questions. Nomsa, so am I correct to say that an emergency fund is almost like an insurance policy, in the sense that what I'm saying to myself is I'm putting X amount in a savings account or a money market account, and it must cover 3 to 6 months of my expenses. And then when things go completely wrong, such as COVID-19, I can then, go and take money from there. And how do I know whether I should do 3 months? Should I do 6 months? Should I try and put as much as I can put in there? What do we do in that kind of situation?
No, definitely. I believe that an emergency fund is some form of an insurance. And also with that, it's able to ensure you from taking money from your long-term goals. Well, let's say, for example, you're putting money aside for children's education, and these unplanned events take place, and you are forced now to dip into that particular investment that you put aside for your children's education. So definitely having an emergency fund is able to insure you from those unplanned expenses. And in terms of really how much should you be putting in, I think your personal circumstances would determine that. It's important for you to look at your lifestyle. So your emergency fund should be able to fund your current lifestyle so that you don't have to downgrade in an event that something happens to you. So have a look at what your income as well as your expenses to kind of give you an idea of how much you should be putting aside in an event that something does happen. And as I've said, that an emergency fund is there to help you manage and recover from those unexpected events that may take place. So let's say, for example, if you were to think about it, let's say this income that you're going to receive at the end of December or mid-December, depending on when you're going to be paid, it is the final income that you're going to get. How much would you want to get in January? Some of us here may say, I want to get 100%, and if not, even more than that. But really, how much have you put aside to cover for 100% of your expenses this month, next month, when you don't have another income coming in? So try and think about it like that, and really measure your expenses to see how much you are putting, if what you're putting aside is enough to cover for those events where you don't have an income coming in. Yeah.
Which was definitely the reality during COVID-19. I know, for instance, me, the last time I actually received an income was in March, but I was saved by the fact that I have this emergency fund that has been growing all this time. So, it was able to cover, fuel, fixing my vehicle, groceries and data. And so it makes so much sense. With you, Emma, there's something you said that was very, very important. And I think sometimes it goes over people's heads. This idea that a vehicle isn't an investment, but it is an asset, and sometimes when I hear people giving out money advice, if I hear financial advisors on social media or people just talking, people will usually say to us that a property is always better than buying a house. A house is always better than buying a vehicle. And I sometimes disagree with people in the sense that we need to start moving away from blanket advice and saying, what is your actual situation? Because my situation could be that the vehicle I'm buying is an asset, but it's actually generating some sort of income. So the vehicle works in Uber or it works in Bolt, or I use it to deliver something. So, what's your opinion on that? Because I sometimes feel like people use this blanket approach where they say, this is completely wrong, this is completely right. But you're almost saying to us, you need to look at your own personal situation. Do you think I'm right in having that kind of thinking?
Absolutely, Tshepo. I think when it comes to deciding what assets, number one, primarily to invest in, is to understand your personal circumstances and what is necessarily important for you and what your goals are is not the same as the next person. So yes, I completely agree with you. We can't take this blanket approach. It's somewhat seen out there. You need to invest in property, but it might not necessarily be the thing that works for you. One of the things that people get caught up in, especially with property, like now we're in a low interest rates environment, which is great for first-time buyers. But the issue is that, you might be able to qualify for that loan, but it doesn't necessarily mean that, you can afford those repayments. So yes, being able to qualify for something, for debt, as opposed to being able to afford that debt is two very different things. So that's the one thing that I wanted to touch on. The next thing is like 100%, a car is not an asset. And by assets, we term it at Allan Gray is something that's being able to generate you wealth over the long term. So if I've just got a car and it's going to take me from A to B, 100%, it's depreciating and it's not necessarily an asset, right? But like you said, if we had to buy that car and use it for something that's going to generate us wealth or generate us income, like Uber, or I think you said something like Bolt, then yes, it is helping us because you're generating that income, and then hopefully you're allowed to, or you can offset the expenses that asset costs, right? So yeah, those are two things that you definitely need to be wary of. So one, yes, you might qualify for debt, but can you afford it? And two, is this asset generating you wealth over the long term?
Lovely. Thank you so much. I think that actually covers Olani Kubega's question, which is about, if you're making an income through Uber or Taxify, how do you then almost say, is this vehicle an investment, is it an asset, what it is? So I think what you're saying really does make sense. It's all about what is the purpose of the thing that you're actually buying into. And then it moves away from the whole blanket approach that no, properties are no, or vehicles are no, and you almost got to look at it from a personal point of view. There's a couple of other questions that are coming in as well from people wanting to know things. One question that's very, very interesting, and I think is quite important, comes from Kgapane. Kgapane is saying, what is the best way to get children involved and exposed to healthy financial behavior? But I'd actually like to almost expand it a bit, because I think even grown-ups don't have healthy financial behavior. So I think the question is more about how do we get our family, our friends, our colleagues interested in having healthy financial behavior? How do we get more people involved and more people excited about money? Is it too complicated? Are we using too many big words? What do you, Emma and Nomsa, think?
I'll take this one. So I actually wrote an article on this recently, and it's about having these types of conversations with our children. I know for us, definitely, like finances was like a taboo subject, right? You never spoke about finances in the household. It just wasn't a thing that was discussed, so you kind of had to like grow up and get these like snippets, either from school or from friends, that might not necessarily be the best advice, but it's, advice nonetheless. And then you take it, and then who knows where you end up. So I think from a first port of call is to like have these conversations with your children. You know, encourage the likes of like delayed gratification. So to say like, you know, if the tooth fairy gives you money, you know, either you can have 100 Rand, but if you don't spend this money and you wait for a year, you know, it will grow to 200 Rand. So it's about introducing those small little concepts to children and having those open and honest conversations with them from a young age. Like if you can't afford to be buying them like sweets at the till counter, for example, I mean, all of those things are there for a reason, right? They're marketing gimmicks. But if you can have that conversation with them and say, look, mom can't afford this or dad can't afford this right now, but maybe at the end of the month, I'll go and I'll buy you a sweet or whatever the case is. So I just think it's important to have these conversations. And I think just to do your homework, like read up as much as you can, like financial literacy workshops like you having here at Tshepo is so important. I think, and I always say this, like, I wish someone had told me like 20 years ago what Nomsa and I are telling everyone here on this call, because I would definitely be in a better situation going forward.
Most definitely, most definitely. One very interesting question that's coming from somebody who's clearly smarter than when I was 16. He says, my name is Heno Nell. I hope I said that right. He says, I'm a 16-year-old investor. Will Allan Gray make it possible for youth, including people under the ages of 18, to invest in one of the Allan Gray funds? So these are young people with very smart questions who are already investing their money.
I wish I was asking those questions at 16.
Oh, Heno, yeah.
So definitely minors can invest with us, but that has to go through their parents, because as a minor, you know, you can't sign. So you can always have the discussion with your parents to open the investment for you. They will manage it for the next 2 years on your behalf. And then when you turn 18, then you'll be able to manage the investment yourself. So because it seems like you're already financially savvy, you can actually even guide them in terms of how they should manage your money. But in that, this is because of the legalities around investments and you being a minor that you can't actually sign for yourself. But you can definitely ask your parents or your guardian to open the investment on your behalf. And then when you turn 18, then you'll manage it yourself and be able to make the decisions and sign for yourself. But definitely minors do open with the guidance, of course, of their parents as well as their legal guardians. Yeah.
Fantastic, fantastic. One other question that we actually received on social media was this question about, you know, we keep hearing that things are not well in South Africa, the economy is not doing well. So if I'm going to buy shares, should I be buying shares in South African companies, or should I be considering buying shares in overseas companies? And I think this touches a bit on the importance of diversification. So, I mean, what do you, Nomsa and Emma, think about that?
Yeah, okay, I'll take that one. Again, it comes down to, you know, what is your goal and what is your objective? Definitely foreign investments are a more volatile investment because, number one, it's invested in foreign currency, and number two, there is that, you know, kind of thing of the Rand exchange, right? So whatever the exchange rate is. What's also important to understand is our flagship unit trust funds that Nomsa spoke of, the stable, the balanced, and the equity fund also have a little bit of offshore exposure in those particular funds. So like Nomsa said, each of those funds invest in a basket of assets, and that assets is cash, bonds, property, and equities. It also different funds have different mandates, and they also can invest up to 30% in offshore equities or offshore companies. So it's important to understand that even if you're investing locally, you still do have that offshore exposure, number one. Number two, you can invest offshore directly, and you can do so through an offshore basic unit trust account, and all that means is we'll handle the foreign exchange, and you're basically investing your money in a different geography or a different currency. And yes, Tshepo, to answer your question, like in a short and sweet, that just offers you diversification. But many people think, you know, you have to invest 100% offshore to get that exposure, but our local funds also have the opportunity to invest in offshore companies.
Okay, that makes so much sense, definitely. One question that we've got, but I think we've sort of covered it now, Emma, is Navi Pillay wants to know, what is the best offshore investment that will allow one to earn foreign currency returns, excluding individual shares? And I'm assuming that's a little bit of what you've just touched on.
Yes, exactly. So you can invest in like foreign assets, foreign companies, different companies through Orbis. You can invest Orbis, which is our sister company, so they do exactly what we do, but on a global scale. You can invest in third-party unit trust funds, which is like other funds that are not Allan Gray funds, or you can invest in Allan Gray funds and they will kind of like invest offshore on your behalf. So all that offers is, it just gives you diversification in terms of, like I said, different geographies and different markets. It's important also to understand that when you are investing offshore, we have R1 million single discretionary allowance. So all that is SARS is saying, okay, here we go, you have R1 million to invest offshore. If you do want to invest over and above that, we will have to send through an application to the Reserve Bank, and there you will get an additional R10 million. So all in all, as a South African citizen, you have R11 million at your disposal to invest offshore.
Lovely. We've got another question here from Mbali Shongwane. Absolutely love her. That's my big sister. She says this, right? How do you calculate how much to save versus your lifestyle? So for an example, a person earns 10,000 Rand, but your expenses are 6,000 Rand. Can I enjoy my life and spend the entire 4,000 Rand, but also still think about saving? So how do you decide how much to actually save from whatever it is that you're actually earning?
Yeah, I think, Emma, you can step on this one as well. But when I look at it personally, I think it's really dependent on your personal circumstances. And really, as I've said, that, yes, you may have responsibilities, you've got debt to pay and all of those things, but it's also important for you to be thinking about putting money aside. And like Emma said, that do not save what is left after spending, but spend what is left after saving. What that really means is that go back to your budget, do a review, see where you can cut off things. There are really, if you really start looking, there are things where you may cut off and say, is this thing really important to me? Is it a need or a want? That's why you're going to sit down and do a review of your needs as well as your wants to try and see where you can cut off in order for you to prioritize building that emergency fund or saving for your long-term goals. Because what we're trying to do is that we don't want you to get to an event or a stage in life where you are forced to take on debt, because really things happen and there are some events that are unavoidable, unfortunately, which will demand us to put in money. So it's important for you to do a review, see where you can cut off. And really, if you feel like it's a stretch, then it means whatever the little that you can do, put it aside, but don't let your responsibilities or your income discourage you from really starting, so that you benefit, as Emma said, on the power of compound interest. Now, instead of you borrowing money and paying those people interest, you have put money aside and you are earning the interest. That's really what we are trying. This conversation is about okay, how do we empower ourselves to earn the interest instead of all the time we are paying the interest? Yeah,
and if I can add, Mbali, great question. So as Nomsa said, the first thing is to look at your budget, but it's like, yes, okay, I need to draw a budget, but how do I draw these like hard lines in the sand? So Tshepo spoke earlier on about like a blanket rule approach, and all of these things are like rule of thumbs. So there is one with regards to budgeting that's called the 50-30-20 rule, and you can Google it. It's, like I said, it's just a rule of thumb, and basically what that says is, in your pot of income, 50% of that income, so in your example, if it's 10 grand, 50% of that income should go to your needs, 30% of that income should go to your wants, and 20% of that income should go to your savings. And, you know, if you have to look at, you know, in South Africa, we have a very, very low savings culture, with only some crazy statistic, like 6% of South Africans that can afford to retire financially independent one day. And that just speaks to, you know, people not saving enough towards retirement. So if you can build these good financial habits from the beginning, from a young age, like all of you guys are young and have this opportunity. Number one, like Nomsa said, you benefit from that power of compound interest, and that's just earning interest and interest. And all that means is you've got a longer time to kind of play in the game, you know, to let your money work for you and let your money grow. We've actually got an investment calculator tool that's on our website. We might send it through to Tshepo, and we'll send it out to you guys. Go on that tool, play with those amounts. See, like, you know, if I invest like 500 Rand or 1,000 Rand, how much will my money be worth in 10 or 15 or 20 years time? I think when people see it practically, then they have a better understanding of how their money can work for them.
I love it. So Emma and Nomsa, from what you guys are saying, if we follow the 50, 30, 20 rule, you'd actually take the 2,000 Rand out before you actually start spending, which links to the quotes that you guys were sharing.
Exactly. You know, like I said, I'm guilty of it. You know, like, oh, if there's money left over at the end of the month, I'll save it. But reality is we living from paycheck to paycheck. So like Nomsa suggested, make that savings part of your budget. So when you're drawing up your budget, put in there savings 2,000 Rand, and then it's gone. And then whatever you left with at the end of the month is, you know, what you can spend on, what you can splurge on if you want.
Lovely. There's a very interesting question here coming from Nico Mabasa saying, hi guys, I just wanted to ask your opinion on a TFSA, which is the tax-free savings account, versus an RA, which is the retirement annuity. This one is a bit interesting because I'm in a similar predicament where I don't have an RA, but I'm actually using my tax-free savings account as my retirement, which some people would see it as a bad move, but it's a personal decision. And I sort of want to think, what are your guys' opinions? How are you guys approaching this?
Yeah, I think, as Emma said, personal finance is personal. So you can use a tax-free investment, for example, to save for your retirement. But as I've said that, you know, there is that flexibility part that in an event where something does happen, you can be tempted to cash in from that money, which will later on affect your retirement. And as Emma just said, now that only 6% of South Africans are able to retire financially independent. So still, then it means that you as an individual, you have to be disciplined to say, okay, this tax-free investment, yes, it's flexible, it's accessible, but I'm going to be disciplined to ensure that I do not touch it. And as I've said earlier, that the tax-free investment kind of caps you in terms of how much you can input in within a tax year. That is only 36,000. But with the retirement annuity, what happens is that with that one is you can put money as much as you want, but the money is locked up. So you will not be able to access it at any point in time until you reach the retirement age, which is according to the fund rules of 55. So at 55, that's when you are able to cash in. That is a third of it. And then the 2/3 is really towards your income when you are retired. That is, you know, when Ogogo, in pension and all of those things, that speaks to that. So really with the retirement annuity, the nice thing with that is that it is tax deductible. What that means is that SARS will kind of reward you or pay you back some money because you contributed towards your retirement. What that means is that the government really is trying to encourage us as individuals to put money aside for our retirement. So with the retirement annuity, you get some tax back, while with the tax-free investment, you benefit from the fact that it's tax-free, you don't pay tax on that, but you will not get any tax back. Also remember, with the retirement annuity, you don't pay income tax, capital gains tax, or dividend tax as well. So really the difference will mostly be in how much you can contribute and also the accessibility of it. That retirement annuity, you can't access it, but with the tax-free, you've got that flexibility of accessing the money if something does happen.
Lovely. So I know that we're slowly running out of time. how do we get in touch with Allan Gray? If perhaps I was very shy, I couldn't ask my question, and I wanna speak to somebody else. How do I get in touch with you guys? Because when you're learning about money, sometimes you feel very flustered. There's so much information. Sometimes you want to take a little bit of time to think and then to come back and to interact with somebody. How do we get in touch with you guys at Allan Gray?
Thanks
Yeah,
for
I
that
see there were a lot of questions that came through, and because of time, really, we were not able to answer some of your questions, but we've just posted a link there in the chat. Please have a look at it, complete it for us, and put your question there that you had that was not answered today, and we're happy to take this conversation offline, contact you, and just do a one-on-one consultation with you to kind of guide you also on investing, saving, and any question that you may have that comes to finances. I don't know, Emma, if there's anything you want to add.
Yeah, just another alternative. So I'm so with you, Tshepo. I get shy to ask questions in front of people. So yeah, like Nomsa said, you can ask us on the link. If you want, you can contact Allan Gray, our client service center. They are extremely educated, and they are more than willing to help. I mean, even if you want to sit and have a conversation with them, they will definitely help guide you.
Fantastic. So just to also wrap things up, I just want to know from you, Emma and Nomsa, what one financial lesson did COVID-19 teach you?
I'll go first. For me, really, it was the importance of having that money set aside. I'm fortunate that, I was able to work and still get an income, even in a time where people were losing jobs, people were getting retrenched. And from the lessons that I got there was having money put aside, me building that emergency fund. Trust me, I'm also in the journey of building that 3 months to 6 months emergency fund, but really the first step is to start. I know you may be discouraged because of what you're going through, your personal circumstances, but take that courage to start. That is really a first step, and then the rest really will follow. As you discipline yourself to put money aside, you will then be able to do it, even sometimes effortlessly. So really for me, it was the importance of having money set aside, because really things can happen that we really didn't plan for or expect.
And you, Emma?
Yeah. I think for me, the biggest thing that COVID has taught me is, as Nomsa said, one is to have an emergency fund, because I also don't have one. And two is, it's given me the opportunity to be more deliberate about where I'm spending my money. So for example, if I was at work, like I said, I'm a little bit of a coffee addict, and I mean, I'm spending like, almost every day buying a cappuccino, and obviously in lockdown we were confined to our 4 walls, so there was no cappuccino buying. And I actually realized like how much money I actually spend on coffee, and maybe I can use this money and put it towards something and save it rather. So I think the one, if I had to walk away with one lesson, it's number one, to be grateful for what I have. And number two, it's to be more discerning about where I'm spending my hard-earned money.
Lovely. Guys, thank you so much to everybody that's joined us. Please do look on the chat box. There is a feedback link that you can click and just give us feedback on the date. Did you enjoy the date? What can we do to make the date better? Did you fall in love with us? Did you fall in love with your money? And of course, you can also contact the client service center at Allan Gray. Just in case you have questions, it doesn't mean that you're investing in something, but you just have a little bit of an interest, because sometimes we feel like we don't have the right to ask questions about our money. And we should be asking, why should I invest in this, and explain it to me in a language that I understand. So thank you guys so much for coming on this date with us. It's all about building a healthy, a loving, a beautiful relationship with your money. So thank you so much to Emma. Thank you so much to Nomsa. Thank you so much to Mbalingiti, to Tshepo who are in the background, busy clicking here and there. And thank you to everybody that came on this date with us. I know we can't see everybody, but please give a high five to your camera. I'm going to do a quick countdown. Emma, Nomsa, you guys ready?
Yes.
Right,
Ready.
cool. 3, 2, 1, go. High five. Thank you guys so much for coming on the date. Follow us on social media. We'll also post the link to this session that we had, and we'll also be answering your questions on social media as well. Thank you guys so much, and have a fantastic weekend.
Thank you.
Thanks, Tshepo.
Bye everybody.
Bye.